welcome this morning to all you, ladies and gentlemen, for the Remarketing Expert Track. This basically is the first session in a sequence of different webinars. We would like to thank certainly our sponsors and also certainly our organizers, because this is a joint organization by Fleet Europe and CARA, the European Car Remarketing Association. And of course, our sponsors, with which we would like to thank, because without them, this would not have been possible. What are we going to do this summer? Basically, we've got a program which you see on the screen. We'll have another session end of August, which talks about COVID-19 impact on remarketing processes, and one end of September, which has a look into the future of used cars. Now we are focusing on the first one, now July 29, which is impact of COVID-19 on market and residual values. We have split this up into three basic parts. We all know that residual value is a lot driven by supply demand, and on its own, supply and demand is driven by a lot of other aspects. Therefore, we split it into three parts. First, we'll have a look at what has happened this year in the automotive market. Afterwards, we'll move into what scenarios can we then see on forecasting the RVs, residual values. And finally, because we've got quite a lot of fleet operators, fleet customers online as well, what is the impact for fleet customers? And the key question there is what's going to happen with lease rates. Before we go into this, I would like to highlight to you that you can always put questions in the chat. We will handle them at the end. Our slides and the presentations of the different subject matter experts will take about 40 minutes, 45, and then afterwards we'll have time for the Q&A. So I wish you a nice time, good information, and without any further ado, I would like to hand over to our first subject expert, who's going to talk about the impact on the market, new and used cars. So I can only say, Marc, the screen is yours.
Thank you, Johan. Great to be here and to be able to show some figures. Thank you, Cara and Fleet Europe, for having me to just show a little bit how the market evolved over the past 6 months and how it's going to evolve next. So I think we can just dig into the figures straight away. So let's have a look at Euro MM5 new car registrations 2020. And I call this the crooked smile. I think I said this in previous presentations. You know, some people call it the Nike whoosh. Actually, if you see this, this is now the registration volume of all the big markets: France, Italy, Spain, UK, and Germany. It started out really good. So the first 2 months were as expected. So that means the levels we gained still in January and February were very good. Then, of course, the pandemic hit really hard in Europe, and we had the first lockdown stuff in March, and in April we really aggregated, hit levels of below 20%. Later on, we see also some country drill downs. We even go lower, but we could say you had a great start. Then we fell hard. We jumped up again, pretty much so. And if you now look at the line, this dotted line, where you can see, okay, everything before is actuals, everything afterwards is our forecast. Everybody thought there won't be a V-shaped recovery. Only China was able to do a V-shaped recovery on COVID so far in terms of new car registrations. But to be honest, June is much better than we also expected it. So we already are now, if you see the line, at about 80% of the previous volume. It's still a considerable loss, and you can see how we estimate the continuation until the end of the year, that we stay at about 80–90% in December. So in terms of figures, we can just take a look. So far, we lost about 2 million registrations in Europe, 2 million new car registrations, and in fleet it was about 500,000. That means if you just do a very basic calculation, it's about 10 billion euro lost in fleet in terms of revenue on new cars, and overall it's about 40 billion. Take that to the end of the year, this will be 2.8 million. So we are decelerating now, so it's not going to be so severe anymore, but nevertheless, we will end up with 2.8 million less registrations. If you think the MM5 hold overall about 10.7 million registrations, and in fleet, we think it will still go a bit further down to about 700,000, 750,000 less than we expected it to be. That means quite a lot of money lost there. And just one global figure to that. So if we just take the next figure, this is pretty devastating. It's 20 million cars not being registered this year, which would amount, very basic calculation, to 400 billion euro in revenue not made. So it's, I mean, it's never been there. And I think we do quite well here in Europe to just, you know, to just go back up. But now let's have a look at the next slide to see how the different countries are actually evolving. So here you can see that Europe is pretty similar, but not the same. So you can see that, for example, France already is using schemes like a scrappage scheme to ramp up the figures back to 100%, which is, wow, which is pretty cool that measures actually work. Extra measures, extra cars. We had that before and it's still working. Also, Italy and Spain are also working on those schemes, trying to push the market into higher levels. But you can also see that Germany's, for example, always different. You know, they didn't go very fast into the pandemic like the other countries. At the same time, if you look at the recovery path of Germany, it's not going to be as fast as the other countries. So Europe is, you know, is not exactly the same. So everybody is a bit, you know, is a bit national driven still, even though we have a lot of European schemes now. So we can maybe just show the next 2 bullet points here, and then we can go to the next one. Now, this is the total market level we just saw. What is really interesting, if you now drill down into the market channels, this is an example for Spain, new car registration, same setup. The first 2 lines you see there, the gray line and the yellow line, is the real market segments, as we call them, or the true market segments. So this is the real demand, fleet and private. And that seems to be recovering faster than the rent-a-car business and also the vehicles which are registered on demos. So this is something which is not exactly the same in all countries, but you can see a general trend here that private and fleets are regaining speed a bit faster than the rent-a-car business. And of course, you know, Spain, Italy, they really live from people making holidays in their countries. So they just don't have the volumes there. And you can also see that even after the June, July, August, we don't see those levels gonna be rising very, very sharply. There are some exceptions. Germany, for example, the rent-a-car rent-a-car volume is already back up very high. But in general, you can see that RAC is low as expected, and demo is maybe low, and maybe people didn't expect that so much, that people who have pressure actually selling cars would use their dealership organizations to park their cars as 0-kilometer cars, and that this volume will be really astronomically high. But we looked at a lockdown, we looked at production stop, and therefore we didn't have so much pressure also on the dealerships actually having to take in a lot of cars. And if you translate that into the topic which Maarten will go into more in depth in the residual values, the market is not swamped with cars yet, I would say. So we don't have that problem right now, what we can see in the figures. So now remember this chart, 25% we estimate overall that 25% of registrations are lost. But now let's look at the cumulative registrations. This doesn't really look as bad. Now, as I'm a bit, yeah, I like statistics. So if you flick through the charts later on, you know, when the webinar is over, you can see they're all same scaled. I didn't now use a scale 50 plus so that it looks really enormously. This is the cumulative loss we have. So we started out with 100%, then in March, cumulated to March, we're about 70%, and then we're going down. And now we're going back up with fleet and private to the levels which I told you about. So about 75% is what we estimate. But for the demos, for example, we estimate about 66% for MM5, different by country. But the RAC volumes is really the one where we think they're hit hardest so far, and that they will also remain pretty low, with the exception of Germany for the moment, as we can see it, that we will have around 56% of registration volume down, which is a really big loss compared to the previous year or compared to what we expected it to be. Now let's have a look what we can take out here. So we really have the economic aftermath is still pending or ramping up in 2021. We don't have to forget that, because we saw the lockdown and we now see levels of registrations coming back up. But at the same time, now we really start seeing things going down in the economy in terms of the recession. That means people going out of business, people being laid off, and that will go on into 2021. And it's very difficult to foresee what's going to happen, but it's not over yet. So there are still a lot of things to come for us to get over this pandemic. Overall, 25% less registration volume. I think that's a figure I think you can remember for 2020. Demo and RAC channels are not used extensively to compensate low sales volumes. I think that's an important one if we talk about residuals. That's not so bad. Maybe a side note on the demo and RACs. I just digged into the used car data a little bit, and for the German data, for example, in June, plus 14% compared to the previous year. June pure. Overall, just 10%, 11% minus. So I think we were 44% minus in April as everything went down, but used car demand is pretty solid, at least in Germany, for example, and in June even above the previous year. EU diversity prohibits a uniform answer. I think we have a lot of care packages, I would say, on the way in Europe, which is excellent. On the other hand, every state uses it differently and went into the pandemic differently and comes out of it. So I think we also see we're going to see those things being still different because of our national interests. We don't even have a Corona app in Europe. We just have it for each individual country. So a lot of countries work differently with COVID, and we will also see this in figures. And one thing more, I think, as lots of those measures which we can see from the European Union are always connected to sustainability, we will also see that the recovery is linked to rising numbers of alternative powertrain. So I think this is basic setup to give you an idea how data works at the moment and how the registrations works. And I hope that sets the scene a little bit for the next speakers. Thank you.
Thank you, Marc. Thanks. I think a very interesting view also because, of course, you split it out and you make forecasts per channel, per sales channel. Yep. If you allow me, just one question there. You mentioned that there's almost a loss. I made a note here about 2.8 million and 700,000 in private and fleet. Do you have a number for short-term rental for 2020 versus 19? Because of course that's going to be a key driver of less young used cars that will be put in the market. I don't know if you got a
Actually,
something
yeah, we have
discussions?
I mean, we looked into the figures found now in preparing for different forecasts to see, you know, what's happening in the market, and of course the rent-a-car really pops up as a major there, and you know, roughly, just rough, it's about 1.2 million cars usually in the rent-a-car business in MM5, so it's pretty big actually, and we think. And if you just do the math on this 56%, we think we are losing about 500,000. So we are left with 680, 700,000, and we are losing 500,000, and which is pretty considerable.
Okay, thanks. Now, that's of course not good news for some in our automotive industry, but of course for RVs, this is not a bad basis.
That's correct.
Because for supply and demand, it doesn't put too much pressure on supply. So that could be a first interesting note and a good one in supporting stability on RVs. Thanks for that, Marc. Certainly stay with us. There will be coming in questions, which I see that is now already coming in, so we can handle them at the end of the session. Okay. So now we're going to move into residual values, and we've got our next subject expert on this here. So I think theirs is a more challenging aspect even on forecasting RVs. I always say, and people that know me will have heard me say this in the past, forecast is by definition wrong. We just try to be as close as possible. So let's have a look at the view on residual value scenario. The screen is yours, Mr. Baljet, Maarten.
Yeah, thank you very much, Johan. Thank you for the invitation. And my name is Maarten Baljet. I'm the Managing Director of Bähr Fess Analytics. And Bähr Fess is a specialist in a small niche, but an important one, and that's the residual value forecasting. So really figuring out what will be happening with the used car market and with the used car prices in different countries, in different sectors. And as you can imagine, this is a topic that we spend a lot of time with at work, not just privately, but also at work, if we like it or not. But it's a very interesting one at the same time, because you don't, as an RV data analyst, you don't have many occasions to analyze a crisis actually. So if there's one, you should use it to analyze it properly and to test the model. And that's exactly what we'd like to do today. The importance is very clear. Every product of ours, even if it's a simple data delivery or a full-blown report, includes this factor one way or the other. So we address it a lot with customers anyway. But today, our goal is to give you a very as clear as possible, a picture which is clear as possible and as transparent and understandable as possible, how we handle with this very challenging question. So in order to do so, I think RV forecasting, it's contrary to how you say, wisdom telling, or fortune telling. It's much more boring actually. So what we do at work, we are structuring a lot. We try to put everything in its right place. And when it comes to residual values, then we have to acknowledge that the residual values, especially this year, next year, but also in 3 years' time from now, they will be realized in a certain macroeconomic development, which means that we cannot talk about the RVs without addressing the macroeconomic development. So that's what we have to do, what we're going to do, but we cannot address at the same time macroeconomic development while we are ignoring what's going on in Europe and outside. So unfortunately, we also have to talk a little about the pandemic itself to really understand what's going on. And this is also first yeah, I wouldn't call it takeaway, but first idea from our sides to really not just rely only on data you're looking at, but also make your own view on these very key questions. So what's going on with the macroeconomics, to read some from different experts or institutes, what they will expect, what will happen, and also with regard to the development of the pandemic. Yeah, let's have a look at the situation where we are today. Actually, today it's exactly 7 months since the WHO has declared a pandemic, and I think we went through a lot. We've seen a lot happening, but unfortunately, still we have no medication, and we have to acknowledge that still, despite a lot of news that you read about it, but there is no vaccine yet available on the market. And that's so in the situation in that sense hasn't really changed, unfortunately. As already pointed out by the previous speaker, Marc, it's important to have a look at different countries. I only have, I think, 15 or 20 minutes time, so we could not address all the countries. We invite everybody who's listening to continue the discussion also together with us, if you like, and also discuss other countries than the one that you see here on the chart. We have chosen Italy, Germany, and France. And yeah, what do you see with regards to the pandemic? Actually, yeah, good news in Italy after terrible situation that no one was ever willing to see. It was really heartbreaking. In Germany also now the numbers have gone down, but at the same time you see in France the development is different. So this is already first important point that we really have to look at what's going on in individual countries, maybe even individual reasons to get a good understanding what's going on, and then consequently assess the consequences on the economy and also on the new and used car markets. What we found out is also that the perception in these countries is completely different. So whereas in Germany there is a more optimistic attitude that the worst part of the pandemic is already over, in France this is not the case. The assumption is that the worst is still to come. So this is a very important information to take away. It's not just Europe, it's really individual from country by country. And we see, of course, that also markets like Belgium, UK, and Spain have been hit really hard. Let's have a quick look at the timeline. What has happened? So I see there's a slight delay, but I will already start explaining a little bit what we can see on the timeline. Obviously, at one point we realized, okay, the virus has come to Europe, and starting with Italy, the restrictions came in place up to a full lockdown in Italy and also in France. I think looking at the charts seen earlier on that we have paid a high price in order to enable the figures, the infection rate to go down again. This is what we have to realize. So the question now is, and we don't know it obviously, but we need to try to find an answer every day to see, okay, what is the right balance between restrictions and giving space to the economic activities and in the civilization. So meanwhile, I think from May onwards, I think more and more easing can be noticed. But the question is how it will affect, and also how people will react to it if they are really going out. Maybe part of the society is really waiting to go out, and others are reluctant to do so. So this is something we have to learn. Okay, next chart, please. So we move our focus then away from Europe for a little moment to look outside of Europe and compare the situation. Because let's say that we have an improved situation in Europe, knowing that the situation is different from country to country. We see that on a global basis, the active cases are actually increasing, and the rate, even the pace of increase is getting higher. So this is really worrying circumstances. For us, the conclusion is, we don't want to be too pessimistic about it, but this pandemic is far from over. The trend is very clear. There's little we know about this virus still, and we have to acknowledge that this is a difficult situation we are in. So what we're trying to do, and now I'm trying to make the lead up to the macroeconomics, then to the RVs, but we need to not follow, let's say, the mood in the market only, but also actually what actually is going on. And the data on the pandemic itself, it's for us, it's worrying. It could actually be that this pandemic sticks with us for maybe even more than a year or even longer. So this is something we have to take into consideration. Now, finishing this topic, what does it mean for our forecasting activities, for our work? Actually, a forecast is first of all, it's a model, it's a structure, and it's filled full with data, but also with assumptions. And at BNF Analytics, our aim is to make those assumptions already always as transparent as possible, so that everyone, when discussing the data, that we always know which assumptions are included in a forecast, and you can better interpret the data on the one hand, and on the other hand, you can also adjust the forecast for your depending on your own assumptions. I think this is what we always like to see, is that we don't only share our view, but we have an exchange, because that's where the RV management is benefiting most. So our assumptions in this case, we would like to focus on the very key assumptions. Obviously, there are many more, and we can go much more in detail, but here we have selected the key factors, the green ones, so the positive factors. Medication, we see already gradual improvements, but there still is no medication, so we expect these improvements to continue. And with regard to the vaccine, I hope this is the right pronunciation, it's our assumption is that, and I think this is this opinion is not very special, but it's a common one, that the vaccine will be available in the first half of next year. This assumption is included in the forecast. So it means that if the vaccine will be available earlier, then there will be obviously an adjustment, a positive one. And if it will not be available, then this is then disappointing, and we have to adjust the forecast in a negative way, depending on the time frame, of course. Second wave, another very common wording today in these days. It's not clearly defined what a second wave, how it has to look like to be a second wave. But let's say that if the second wave is defined as a accumulation of new infections, which forces let's say the governments to take drastic measures, then this is let's say definition we can work with for today's session. We see a very high and also increasing risk, knowing that, for example, in France, actually the first wave is still rolling. So But at the same time, we think that the second wave, it can be avoided if the social distancing is working, thanks to intensified testing. So you're quicker aware of what's going on with the virus, and it allows the governments to react quicker and also on a regular basis. So this is a huge advantage. This is why in our assumption, in our forecast, is that the second wave can be avoided, but we have to say that there is a high risk it will come differently, and then we have to say that the forecast has to be adjusted in that case. Okay, then we come to the second part, come to the macroeconomic picture. So what do we see on this chart, which will be displayed, I think, in the next seconds? Macroeconomics, we have thousands of macroeconomic factors which you can analyze and look at. But I think especially for today, but also to be honest, in our work, we try to figure out which are most important and actually are related to used car, correlate with used car price. So we would like to focus on unemployment rate, on GDP growth, and inflation. I think unemployment is clear. If you have no job, your budget to buy a used car is lower. GDP growth also clear. Inflation, the price, an increasing price level, obviously also includes the used car prices. So for consumers, inflation has a negative connotation. You don't like if you have some kind of, if you have money on the bank, inflation is a bad thing. If you have a car, let's say it's a leasing company, inflation is actually is great because the price is increasing. So if you set your residual value too low, you can at least hope for inflation to compensate for it. So these are really the key factors we look at. What do we see? We see also, because the data is going back to 2005, we can also see the period of the previous financial crisis, which was, we don't want to elaborate too much on that, but in some ways similar. It was a crisis, the demand reduced, but in many aspects completely different than today's crisis. Anyhow, it's included in the chart. Maybe we can skip back again to the previous one. What we see here, is that, for example, we have 3 different countries again included, and we see, for example, that in Italy, in Italy, that the unemployment rate has risen until 2014, when the crisis, let's say the real crisis, had already been declared over. In Italy, the unemployment has kept rising, but from there on, it decreased. It has decreased, and I think in the past two and a half years, it's fair to say that the economy has developed really well, and this is taken into consideration when analyzing used car data from the past years, that the conditions were, well, really positive. But when making a forecast, we have to create a new macroeconomic scenario which fits to each year that we forecast. So now we'd go to the the next chart, because the past charts, they show the development until 2019, and then of course, when forecasting, we have to forecast also the macroeconomic development. Actually, it's not our job to do that. We are not specialists for that. We buy the data from a specialized company to look at the future development of these key indicators. And then we use our macroeconomic model to bring these data and these developments into relation to the used car market today, next year, and in the future. And on the left side of this chart, you can see our macroeconomic model before COVID really hit the European markets. I think this one is from January, maybe early February. And you can see already that the price index is a positive one, which means that positive price developments were forecasted, especially for France, which has already developed very well in the past 2 or 3 years. And the expectation has been that this would continue. So France was or has been doing really well. Yeah, but then of course things changed, and we had to update the macroeconomic input. And what happened? Unfortunately, I cannot show all the precise data, but I got some data with me, and you can see the summary on the right side of the page. So obviously for 2020, all the signs are let's say worst case, more or less. So it's the unemployment is increasing, the GDP. In these trends, they as they are shown here, they apply to these 3 markets, to all of them actually. And the unemployment is increasing, the GDP decreasing by let's have a look. So that's Germany, the decrease is its lowest, by already minus around 6%, and in France it's and Spain it's almost 10%. So this is really a very unusual and seldom situation. It shows the extent of the crisis. And this, I think, this is the first part. Then, however, looking at the next years to come, the picture is changing again. I already heard this the Nike logo being mentioned, and it fits very well to what we see or what we hear from various different macroeconomic experts. They have different forecasts, that's clear, but also depending on the institute, depending on the country, that's clear. But they have also a shared opinion for some assumptions if you build groups when analyzing the data. All of them, they expect that there will be a steep increase again next year, and then this trend will continue in the successive year. So we'll have higher growth rates, not just next year, but already also in the years afterwards. It means that, of course, we have a crisis today, that's clear, but we are gradually, getting out of the hole and improving again. And the numbers are not as strong, so we don't have compensation already next year. That's not possible. Nobody, none of the macroeconomic providers actually of the data we have seen is forecasting that. Also not for Germany, but there is a strong counter movement, and then a high growth rate in the years afterwards. The same applies to unemployment and price level, which are also developing in the right direction. So this is already a very positive outlook into to next year and the years thereafter. So next page, please. Yeah, besides that, let's go through that quickly. Johan, how much time do we still have? Okay. We move on to the macroeconomic, to the EU recovery plan. So this has just been announced, I think 1 week ago, that there will be a 750 billion recovery plan. 390, so most of it will be financial aid, not a loan. The only problem is that it will be spent only in next year, or in the next 3 years, but not in 2020. It's not possible. The countries which will benefit most are Italy, Spain, and France. So this is an additional boost to confidence in the market imminently, especially as soon as the European Parliament has signed off this proposal or this decision. And then factually in the years to come, this will give additional dynamics to the market, which also has to be taken into consideration and can also lead to higher macroeconomic forecasts for this period. On the other hand, though, and then we go to the next and last.
I'm sorry to interrupt, Maarten. Could you move a bit faster, because we probably for you have only 3 minutes or maximum 5 maybe, but
5. Okay, 5 minutes. Thank you. So then just quick on the positive side, the economic recovery plan. Huge risk, however, coming from the US. You see the infection rate increasing very steeply, and we also build a price index for the US economy, and it's much worse actually than what we've seen in Europe. So the main problem lies in the unemployment rate, normally between 3 and 4%, now forecasted at around 10 or even higher than 10%, and not expected to go down quickly. So this is a huge risk we have to take into consideration. Then we come to the key part, the effect on the current and future used car markets. The first point here is that it's already mentioned, used car prices, contrary to new car prices, are the effect of supply and demand. We have spoken a lot about the demand side, which is led for the overall market by the macroeconomic development. Supply side has been addressed by Marc Odinius, and I think Dataforce offers very valuable data, especially in these times, also when it comes to residuals. That's the interesting takeaway, because it shows really half of the equation. The macroeconomic half, I think it's clear, but it's with sales channel data, you can really figure out which cars will return, in which age, how old will they be, and when will they return. And this is a key factor when making forecasts in different markets. So what we do, we look exactly what are the sales today in different markets in continental Europe, if a continental European country is concerned, because imports and exports are of course and will be possible. And then the differentiated approach per sales channel to really see which cars are really gone when they are sold. You'll never see them for our relevant time frame, and which cars will return in which frame. Then looking at the used car prices, which you can observe in the market, actually they show one side of the picture. We can measure clearly that the prices are decreasing, but not as steeply as you might have expected. And we also think that the observed price level, they don't show the full picture of the market. They don't show the full impact, the full extent of it. Why? Well, I think the reason is obvious. This is related to simply trade barriers to sell cars, first of all. So the trading amount was much lower. Cars were not even offered on the used car market, and leasing rates, and this is a great reaction by many professionals in the market, where leasing contracts were simply extended. So in order to get a realistic picture of the used car market impact, we have to look to take into account again the macroeconomic data. And what you can see on the next chart, the used car price index of 2020, you can see for the 3 countries that we have addressed the price level of 2019, which is set at an index of 100. And then our assumption based on the macroeconomic model, which was made beginning of the year. And what you can see, for example, is that for Italy, we assumed a slight decline of the overall price level. After COVID, we had to make an adjustment. Actually, the model did it for us, but you can see the result. It's 5.2%. In Germany, -4%, and in France, -4.8%. It's an average value, average for the market, but also average for the entire year. which means that the dynamic within the year, it also includes the positive beginning of the year. And it has to be taken, of course, into consideration. So you can go much more into detail, maybe not for today, but this is the starting point. So a severe reaction on the used car market, which there has to be simply due to the weak economy. But now let us have a look to the next year, 2021. And remember, having in mind the numbers that you still see between 4 and 5.2%. In 2021, we can see that those numbers will be lower. So that means that the difference between the assumed used car price level before the crisis and the currently forecasted used car price level is reduced, now amounting minus 2.4 and minus 3.4%. So the problem will still be there, but will be smaller. I think the key question for today will be, okay, so you see the recovery of the market. The question is, what will happen if you buy a car today and you want to a new leasing contract has to be signed? What is the forecasted residual value in that case? So let's have a look also at the 2023 numbers. Again, these figures are based on these key indicators, which are forecasted by macroeconomic specialists. And then we go to the used car price index 2023. Thank you. And what you see here, interestingly, that actually the gap has almost been closed. So in Italy, minus 1.2, almost the same in Germany, and in France, it's only 1%. 1% means in this case that, or minus 1 point in this case means that the residual value will, in absolute terms, will be the used car value will be 1 percentage point lower. Now, as we already said, this is the macroeconomic model. Now we take the information we have from Dataforce. That substantial, like as far as I know, never seen before cars are missing, and they cannot be replaced. You cannot buy them at a later stage because they will return also later. And this effect on the used car market is in an area of a margin can amount up to 3.5 percentage points or even a little bit more. This means that looking at the data for 2023, where you see the already vastly improved economic scenario, knowing that there are still many risks on the table, that the effect of the missing cars in the market is much stronger than the slightly negative impact of the which will still be left in 2023. So it means for the residual value that you forecast today for a new car should be at least as high as what was forecasted before the crisis. And that's also the conclusion for my part of the presentation, that we will have a recovering economy with many risks, and at the same time lacking cars, so a shortage of cars on the used car markets in Europe, one more than the other, that's clear. But this is it means that the residual value level can not only be held, but even will be somewhat higher than what was forecasted before the crisis. Johan.
Okay, Maarten, thanks very much for your input here. I know it's very challenging to give a very complicated subject in a very condensed way. So I understand that it was a challenge to stay within the timing, but we're going to try and certainly see that we can catch up. But I certainly want to give the time to Yves as well. So as a summary, what I see is that on the midterm or within 2023, the loss will be not maybe there, taking a lot of assumptions, which I know you have to do. Now I'm going to pass the word to Yves Helven with the key question is, what would this mean for fleet customers, for fleet operators? Because on the one hand, experts don't paint a bad picture for 23, 24, On the other hand, we hear from risks of internal push at anyone who needs to set RVs to be a bit more conservative, which could lead into higher lease rates. So I would like to ask Yves if you could share your view what the challenges are for fleet customers, fleet operators. I've seen on the list that we've got quite some of them here, so I think it's very appropriate to take the word here. Yves, all yours.
Okay, super. Johan, firstly, thank you for having me, and also thank you to Cara Fleet Europe for organizing the session. So quick intro, I work for Fleet Consultant Connector based in Asia, Europe, Australia. Main activity is to give advice in fleet management, mobility, technology. So it's a pleasure for me to talk to the remarketing audience today. So for the audience, Johan contacted me a few weeks ago with an interesting question. So he wanted to know what the impact of COVID could be on the total cost of ownership of a corporate fleet. So it's an interesting question for many reasons, especially because there is a short-term technical answer to the question and a long-term, more strategic answer. So I decided to talk to a few of our clients, and that's what I'm presenting here today under the title Undefaulting the Company Car. Just as a quick side note, as a company, we talk to the typical Fortune 500 type of client and not that much to SMEs. And obviously the SME business is also a very big leasing / remarketing trench of the total business. So don't take what I'm going to say as the absolute truth. It's a representation of what corporate clients are saying. But first, let's go back to better times and have a look at what was happening with the corporate client before the pandemic. So I've listed a few topics here that were defining corporate strategies in 2019. So firstly, digitization of business models, which means that cars are becoming less necessary to keep a company running. Generational challenges with a new generation that still likes cars. I don't believe that new generation all of a sudden is hating cars, but they prefer utilization to ownership. Then the next one is a really important one. We're moving from rigid benefits to flexible benefits. It's a big shift in the total rewards world. So employees today still typically have a salary, health insurance, and a pension fund, but employees are asking for much more flexible benefits. Why is this important? It's because mobility as a solution fits really well within the flexible benefits world. Then furthermore, underutilization of car fleets. So especially, and this is an important one, especially procurement people look at the utilization as the next big savings opportunity. So they're just waiting for a black swan event to start reducing the fleet size. And guess what has just happened? Then next point is increased tax load of company cars, something that's been going on for a couple of years, and I don't expect that to change in the good direction. I think we can expect a heavier tax load in the future. And then finally, city bans, also something that corporate clients are struggling with. You know that all European cities are gradually making it more difficult for cars to enter. Next slide, please. So this is like the reality before COVID-19 broke out. So now it's time to have a look at the new COVID realities. So COVID can have two types of effect on corporate strategies. Either these strategies change entirely, 180 degree, or the existing strategies are accelerated. What we see within our client portfolio is that we are in the second case. So Corona is a catalyst. Let me share with you what fleet managers are considering right now. So they have, as you know, we're all doing digital conferences, we work from home. So there's an acceleration of the digitization of business models and home working. So from a tactical point of view, everyone understands that there's less needs for car kilometers. And some companies, and this is an interesting consequence as well, some companies are saying that there's less needs for salespeople. The second point is electrification. It would be too much to say that it's on the agenda of every client, but EVs are clearly gaining traction. HR strategies to support employee wellness. So the post-corona employee is not the same as the pre-corona employee. And HR is now dealing with totally new requirements in the HR world. And their focus is not that much on the company car as an isolated solution. So whatever is going to come next will need to be part of a benefit of a total wellness HR benefit strategy. Then further underutilization of car fleet, heavy focus on savings. We hear it from each one of our clients, except for a couple of famous pharmaceutical companies that are doing well right now. But each of our clients is looking for savings. And then the last one is maybe also an interesting one for the remarketing community. Clients are starting to become more interested in new form factors. That means that, for instance, in Europe, they're starting to look at e-bikes instead of cars. We have clients in India who are massively moving into electric three-wheelers, rickshaws. We're looking at clients who want to replace four-seater cars with two-seater cars. All that kind of stuff is happening in the background as well. So clients are not only replacing a car with an alternative solutions, which could be mobility or public transport, whatever. They're also looking at replacing a car with a different form factor, right? So these are trends that are being accelerated in this COVID world. Slide, please. Bit of a controversial slide. We see that our clients are looking outside of the traditional supply chain of, typically OEMs and leasing companies, because their feedback is that the traditional supply chain is not catering for the post-COVID needs, and even not for the needs that were leading up to COVID. So the biggest issue here is that the delta between the offering of the traditional supply chain and the demand from the client was already becoming bigger pre-corona, but now it's becoming a gap that needs to be addressed quickly and thoroughly. So I've listed in the two columns what the trends are at the supply chain side on the left and the reactions from the client on the right-hand side. And you'll see that there is almost no intersection between the two views. And again, it's something that the industry needs to pick up, because otherwise we're going to end up with a supply chain and a client community that is no longer catering for each other. Next slide. So conscious of time, I'm just giving you here a very high level model of what next generation fleets could look like. So what you see on the left-hand side is, let's say, a fleet of about 1,000 cars, typical European fleet, multiple country, 1,000 cars. And on the right-hand side of the little graph, you see what we anticipate is going to be the next corporate fleet model. It still has a number of cars, but less than before, and it adds two new elements, which are a flexible car fleet and a mobility element. So by flexible car fleet, what we mean is that a company today will realize what the minimum total utilization of their fleet is, right? And they will cater for the number of cars, or they will, buy, lease, whatever, that number of cars as the basic fleet size. On top of that, they will foresee flexible buffers of fleets to cater for seasonal effects and punctual needs. On top of that, we have the mobility, right? So the mobility and the flexible car fleet, and this is an important shift, is not there to replace a car as such, but is there to replace trips, right? So we're moving from asset-based fleet management to trip-based fleet management. And this is, what you can expect for the next couple of years, a fleet composition to look like. The most important thing that you need to remember from this slide is that not only there's going to be a new model, but also that the TCO, the total cost of ownership of employee movement, needs to decrease. Right. Next slide, please. So now it's time to answer Johan's question, what will happen to the TCO of a corporate fleet? So there's, again, tactical short-term and strategic long-term. Short-term, and this is for the existing fleet, TCO is going down because TCO needs to go down. Cars are driving less, so TCO will go down. Cars are driving less means less kilometers, less fuel, and so on. So there's like an automatic effect on the TCO of a car fleet. if the client decides to recalculate the contract, they will actually make some savings on that recalculation, but they will also postpone the order of a new car. And clients are expecting that that new car will be more expensive, right? So the clients don't have the science that everyone in this community, in the remarketing community has, but clients are expecting leasing rates to go up in 2021. On the long term, and we saw it on the previous slide, the fleet manager has no choice. The TCO needs to go down. And almost all fleet owners have savings targets or sustainability targets or efficiency targets. And all these targets lead to fleets with less cars. So we're also seeing more fleet owners investigating outright purchase or fully unbundled products. I don't expect a massive transition from leasing to purchase anytime soon, but our clients have started to try it out with a few cars and some new software. So Johan, I hope this answers your questions with regards to TCO. Short term, maybe a bit of savings to be made. Long term, client anticipates an increase of TCO if they don't change anything, but they're starting to be willing to change the way they look at fleet and mobility.
Thanks very much, and also for your help in catching back a bit of time. That's a problem. Just for time, I think we're gonna keep. I'm just gonna take one question per speaker, while you see on the screen the other programs that will come end of August, end of September, where you can subscribe. So I would like to start with Yves, maybe because then it's for people still fresh what you actually said. The risk of increasing lease rate, do you think this could lead into an effect of fleet operators taking residual value risk themselves and eventually even doing vehicle and handling the remarketing themselves as well?
So there's clearly an interest in outright purchase and in unbundling. So the client really doesn't look at it, well, do I want to take the risk on the residual value? But the client is looking at, what kind of solution do I need in order for my fleet to transit to a more modern model? And if the supply chain is not offering it, then maybe I should buy, let's say, electric vehicles myself, because I suspect that I can sell it better, or someone else can sell it better for me than the leasing company anticipates in terms of residual value. The second fact is IFRS 16, right? So leasing is now on balance, of, let's say, at least the capital part and the interest part of a company car vehicle is on balance. And the CFOs are starting to think about that as well, especially those, unsurprisingly, cash-rich companies are starting to think about purchasing vehicles. Then the second part of your question, will clients ever do remarketing themselves? I don't think so. It's the trend of staying close to core business is a long-lasting trend, and I don't see a pharmaceutical starting to sell cars all of a sudden. But there is perhaps a market for a good supplier that could take care of vehicle disposal with the necessary guarantees and operational efficiencies. So answer is yes, I do anticipate more unbundling, more purchase, but the supply chain needs to provide for a solution to manage that and to manage the disposal.
Okay, thanks. Another question for on residual value. So looking at your economic forecast of RVs, Maarten, I think and it was a question here posed is, so it looks to be more reasonable to take contracts of 36 or 48 basically a month instead of 24, because within the next years, 2020, 21, maybe 22 might be a bit of a challenge on RVs, but then afterwards it looks much nicer. Do you agree that that would be a safer option to take contracts a bit longer?
The simple answer would be yes, because the economy will be stronger based on the forecasted macroeconomic data. So that's a more beneficial environment to sell a used car. On the other hand, in general terms, besides COVID, it's always worthwhile to look at how does the used car market looks like in the respective country. How many, depending on the model, how many used cars are already available as a 2, 3, or 4-year-old car, and include this into the decision, obviously. But from a macroeconomic perspective, yes, the environment will be more favorable for selling a used car.
Okay, good. Now, we had a few questions on whether there's a difference in performance as well in market and in RVs, looking at EVs versus diesel versus all the different combustion engines. So maybe a question for Marc, because I know this is a big interest of you as well. Do you see any different development in forecasting in the future that has changed after COVID-19 regarding ICE vehicles versus EVs, for example?
Yes, we would do so. I think it's still difficult to foresee the real development there. But what we already see in the data is that we are higher on this on the BEV or PHEV vehicles compared to what it should be now. And now with all the measures coming up, I think there is a true chance that we get the transition into alternative powertrain a bit faster. On the contrary, I must say what Yves said also, quite a lot of targets of big fleets are ranging around reducing things, not just reducing costs, but also in that sense reducing CO2 footprint, having targets to go EV. So they also will have a big impact on this one. And COVID is really an accelerator to that. We see that in the figures right now. Of course, one thing I think is really, really important, and we are working on a study regarding this one. I think for the fleet managers, you need to have something which needs to be sustainable in the sense of taxation as well. It can't go up and down and up and down and up and down all the time, like maybe in the Netherlands, where you really have a problem that it's only for the driver, not for the fleet. If you have incentives to use BEVs or PHEVs, and I think that's an important one that the governments understand also, that you need to calculate into the future, and of course charging infrastructure is a real difficulty right now still throughout Europe, because we see the manufacturers getting out their models, we see the mindset of people and fleet managers changing in that respect. So you have those two equations, but you're still lacking some regulations and especially the infrastructure. And I think if we have a big push there, even though it's not so popular, I think we will see the adoption cycle speeding up.
Okay. Thanks, Marc. Now, I see throughout today, we had a lot of questions on a lot of details as well. What I would like you to do is just post your questions to any of your contacts as well. And if you would like, we can handle them afterwards, or even handle them together with you. Hereby, I would like to close this session. I would again like to thank a lot the two parties who have organized this, Fleet Europe and the European Car Remarketing Association, CARA, and of course, much appreciated our sponsors. And we will leave you just with a view on the sessions of end of August and end of September. I'd like to thank you for your attention and see you end of August. And stay safe. Have a good one.
Goodbye. Thanks.